What's up, trader? How many times you have this experience that you said, okay, euro dollar give me a nice looking bearish setup. I'm gonna short from here, stop loss above this high, take profit maybe 1 to 2 weeks to reward. And as soon as you took the trade, the price just hit you to stop loss and then came straight back to your profit target. How does it feel like? I know that it feels really awful. Now, if you are trading for some time, you do have this kind of experience many times. I did have to when I started trading. And I know that it is really a daunting task for a trader to find out exactly where to place a stop loss and where to place a take profit target. Once you know that, you are almost 50% ahead in the game of trading. So with that being said, in this video I'm gonna show you exactly how you can determine a proper place for stop loss and take profit. Keep in mind that no one can guarantee you a stop loss place where it will not be hit. There is always, it's a part of game, but once you know exactly what location is better, it will always give you a big edge in your trading. So if this is something you are interested in, make sure you smash the like button, hit that subscribe button if you haven't done yet. This is Forex Wizard from Forex Trading Wizard Academy. With that being said, let's get started. Okay guys, so before we go to the area where we should place our stop loss or take profit, let's first find out where you shouldn't place your stop loss at all. The most important area that you shouldn't place your stop loss at all is area of value. Keep in mind that area of value is the zone is mostly tested always from both direction. You see that most of the time the area of value is very important zone is always tested, and try to avoid at any cost to place your stop loss in an area of value. I'll show you in the chart how it looks like where you shouldn't place your stop loss, but let me explain the theory behind why you shouldn't place an stop loss in an area of value. Now if you see this kind of area of value, okay, you see that this level is where the high liquidity, and liquidity act like a magnet with the price. When you see a what is in fact in the first place an area of value? Area of value is a level that has been tested multiple times in the past. For example, the price came here, okay, bounced from this zone, came back down again, came here again, bounced from that zone, creating an area of value. It could be support, resistance, trend line, but that because in the past this level acted here as an area of value, the price bounced from that zone. Highly likely that the price will go up again, either will break this level or will have another bounce. And if you place your stop loss in an area of value, highly likely that you will have a stop loss hit. Then where should you put your stop loss? In fact, is just above the area of value? I would say that no, even not just above the area of value. Why? Because as you know that 90% trader lose money, only 10% makes money. That means that 1 out of 10 makes money, 9 lose money. The reason is everyone think that the stop loss should be above area of value, and because everyone thinks, everyone put their stop loss above area of value, only the smartest do something differently. Why it is difficult for you to maintain a good trading, good profit in your trading when you are placing stop loss area of above area of value is because, let's say you sell from area of value, okay, let's say you short from here, you stop loss just above area of value and you target it here. Now once you sell from a zone, when you place your stop loss in fact is a buy order. This is the concept that you need to write down multiple times to understand. The market moves interaction between buyers and sellers. So once you sold, keep in mind your stop loss is a buy order. And big boys sometimes create, most of the time you'll see that manipulation. The price goes up, hit your stop loss, and then started to drop again. The reason is you sold, big boys also want to sell. But if everyone is selling the market, then who will be buyer? And that is why they manipulate the price to go there. Some people they manipulate, some people say it's a slippage, whatever. The price goes there, okay, and then from that zone we see that the price hit the stop loss. That means you turn into a buyer and the price starts to drop. Then let me show you an example, and then I'll tell you then where could be the best place for placing a stop loss, and then we'll see how we can place an entry as well. So if you look at this example, this is euro dollar. Let me show you why it is so important to understand it. Let's say you see that this level, exactly this point is where the price previously bounced, and this level also the monthly level of support, monthly level of resistance. You see this is the monthly chart, and exactly this is the point where the monthly resistance level. And if you go to the 4-hour time frame, you see that this is where the price bounced and created this big move to the downside. Okay, it's a big drop happened. Now when the price reach that zone, let me replay this chart, then you'll understand it what I'm trying to explain to you. Let's say you saw that with this big long green candle, the price hit that monthly level of resistance. So there is a lot of confluence in this candle for shorting. The reason is, first of all, major trend on euro dollar is down. The price hit a very important level, monthly resistance zone, with a big long candle in the opposite direction of the trend. A long green candle hit that important level. So there is a lot of confluence for this price to drop, and as a result many traders will short this market. Okay, from this zone they will say, okay, this is a very good strategy. We can short from here just above the high. Okay, stop loss maybe 1 or 2 pip above the high and keep a big profit target, right? So let's say you run that trade like that, and just for maybe less than 2 to 3 pips it hit the stop loss, came back down, and look at this. After that, what happened? It in fact a big move happened later. If comparison with the, if you take this trade, let's say if you're a winner, then up to 20 times profit you can take from this trade. Okay, but then why only 2-3 pips give you a big tragedy in that trade? And that is what you need to understand, that do not place your stop loss even just above the area of value, because if that's the case, everyone knows it, big boys knows it, they will manipulate and slaughter the retail trader and will go to the direction that you intended to go. So then where you can find a proper place to place your stop loss? As I told you that no one can guarantee that always your stop loss will be safe. When we trade, we also had a stop loss hit, but how you can find an important zone that could be a high probability for not to hunt you? So the first thing, the most important concept that I apply is I wait for a manipulation to happen. Okay, this is the most important part. Keep in mind that when you see an area of value and then a manipulation happen, then you know that what is the level that manipulation has been done. The stop loss should be above the manipulation, and that is where high probability that your stop loss should not be hunted. The reason is stop loss hunting is a part of game. You know that the whale is no more not hungry anymore, so the price is ready to move and you can take that flow of trade. So let's see a couple of examples, then you'll understand. For example, there is quite a few examples you can see in the market. This is a very regular phenomenon. Look at this one here. You see that, let me replay the chart so you understand. This is the same thing on euro dollar. Okay, you see that the price has created, there is a kind of reversal pattern here, double bottom. You see that in an important area of value in this support zone, and then the next candle on the 4 hour, see that the price came back down, broke this level, and then created this bullish engulfer with a strong momentum, and that has given you a big edge. Because let's say when you saw this market with this doji, you might say, okay, there is a double bottom here on the 4 hour time frame, nice looking double bottom. The price has broken out, the price tested the neckline, exactly the neckline, okay, the previous resistance here, turn support, rejected to the upside. I'm gonna short this market from, I'm gonna long this market from here, stop loss below this candle, okay. And then once you took this trade that way, it's gonna do, it just hit your stop loss and then started to move in the direction. But what if you wait for the manipulation candle that has already hunted millions of retail trader? So that candle in fact has a huge volume, because this candle already manipulated to the downside, so it is now ready to go to the upside, and your stop loss should be below the manipulation. So you are always escaping the danger zone and staying in a comparatively safer zone, and that could be a very good trade for you. If you go long, that is an awesome trade, and you can see that it's easily achievable. So if you look at quite a few examples in the similar way, you see that when you wait for a candle in the direction of the trend, when you see the manipulation is done, that is where the high probability. Look at this one here as well on the same instrument on euro dollar. You see that the price already, look at this one here, the price went to this zone, okay, to this resistance, and they started to reverse. So this candle already manipulated once. See, the price already tested the resistance and created this strong rejection. See the next one, what happened. Okay, the next one had a huge stop loss hunting. You see that when the previous candle formed, this one, when this candle formed, many traders in this zone were shorting this market, saying that, okay, I'm gonna short from here, stop loss above this high, okay, because this market already created a manipulation. The price is reversing, okay, very good place for reversal trade. And once you take this trade, you see that just hit your stop loss and started to drop. So once you saw that the clear manipulation is done, has broken the trend line and then closed back with this middleman, that is where you should trade, and you can place your stop loss just above this manipulation, and that is the best place for entering a trade with a stop loss above the manipulation. Now let's look at where can you set your take profit target. Okay, now let's talk about take profit target. Now when it comes to take profit target, it becomes really tricky. Many traders handle this in many ways. Some uses trailing stop loss, some uses mathematical risk to reward ratio, some uses area of value. Let me discuss all of them. Let's see which one is fitting mostly in your trading style, because everyone has a different kind of trading style. When it comes to stop loss, everyone almost in the same boat, but when it comes to take profit target, it depends on your strategy and trading style. Now let me discuss all of them, then you'll see which one best suitable for you. First, for example, for trailing stop loss, if you are trading with the trend with the open take profit target, if you can hold the trade for long period of time, trailing stop loss could be an option. Now for example, if you open a trade from here, okay, let's say you long from here, stop loss below this low, after seeing this reversal and you say that okay, I'm gonna hold this trade for a long time, then how long, how should you trail your stop loss? See, when you trade with the trend, the price normally move like this, create an impulse and then come for a correction, retracement, and then create another impulse, then come for a correction. In that correction, what you could see that the previous resistance zone turned support, tested, and then created another impulse. Now if your entry in this point here, okay, and you saw that the price created this impulse, came back to the correction, you wait for the price to do the correction, okay, and then once you see the previous swing high is broken and candle close above, in most traders, what they do, they bring their take profit target stop loss here. So once you bring your stop loss here, that means that you secure this profit target, okay, you secure this profit. And then once you saw this impulse, wait for another correction. Once you saw this correction, the tested the previous swing high, previous resistance as support, wait for another impulse. Once this impulse is done, that means that the price already has broken this resistance level, bring your take stop loss here, so you secure this much profit. And based on, as long as you see the trend is valid, many traders keep running the trade until you see a clear reversal in this zone, let's say a double top, and then has broken down from the double top, then many traders close their trade to secure this much profit. Now if I show you that on the real chart, for example, if you consider this one, then how you can do that, let me show you. For example, you trade from here long Aussie dollar, stop loss here, okay, and you keep your take profit open. Now once you saw the price has created this impulse, this correction, okay, and then once you saw this high is broken, then what you could do, that you can bring your stop loss along this zone. Let me draw this level so it becomes easier. You can bring your stop loss just above this neckline. Why? Because the reason is still this top has not been tested. So if you see that this level, which in the past acted here as a support and here as a resistance, as this level has not been tested yet, highly likely that the price may come to test this level. And if you move your take profit too far, you might be out of the trade with a little profit if you want to hold the trade. So you found the level, your stop loss in that case should move to this zone here. And then once you saw that this swing high is broken, let's say this swing high is broken, impulse created again, and you have seen another correction, and once it has started this impulse, you can move your stop loss along this zone to secure this much amount of profit. In that case, you can move your stop loss just above the swing high, as it has already created this candle. And that's how you can trail your stop loss until you see a clear reversal pattern and change of trend. This is one way many trader does trailing the stop loss. Another way is to use a mathematical risk to reward ratio. So what does it mean? It means that, for example, once you open the trade, if you have a back tested strategy, that let's say you back tested strategy all the time, you take 2-to-1 reward to risk or 3-to-1 reward to risk in all trade regardless of everything, then you might be able to find a take profit zone regardless of levels. You just place by mathematical risk to reward. That means that whatever trade you open, you take profit always 2 times or 3 times more than you risk. In that case, you don't have any preference for levels or anything like that. You manage your risk and let the trade hit the take profit as long as it takes. This is another way of doing, as I told you, that based on your strategy. Another way is to find an important area of value. So let me explain that as well. For example, let's say you wanna sell this market after this bearish engulfer, okay, long bearish engulfer Aussie dollar. You have seen that. Let me replay the chart so that you understand it. You saw that the long-term trend here is down. Okay, it's long-term trend, and looks like that this one is a liquidity grab, and the price has broken strongly to the downside, signaling a change of local trend to the global trend. So what are you gonna do? You're gonna short this market from here. Is stop loss probably above this just neckline, because it might be too long for you. Now where should you place your take profit? Okay, so in that case, what you could see that there is the nearest zone where you can find your take profit target is here. You can see this is the previous support zone, nearest level. There is also a level, but recently the price came up to here, and some trader, sometimes I do too, that to secure quick profit could place the take profit target in this zone in the nearest level. So nearest level means you see this local downtrend creating series of lower high and lower low dropping in this direction, and this is the local trend that has broken and went to the upside. Highly likely that the price at least will come to test this level, and that is where we will be securing the profit. And this is used in most of the time in a high probability setup that I sometimes use, because I want to take the profit as fast as I can with a high probability trade setup. I do hold the trade also. It depends on what strategy I'm using. So with that said, as I told you, even it could be you could place your stop loss above this long candle, because there is a manipulation and you could want to save your capital. In that case, even if it is a low risk to reward, but it's a high probability setup. So that's what you need to understand, the concept of probability, rather than always stick to risk to reward. So this is how you can do that, placing the take profit in an important area of value, because there is a chance again to have a bounce from that level. So these are the three ways you can set your take profit target. Now the rest will depend on what kind of strategy you are using, which is trading style, and which one you like most. Thank you very much. If any other way you know, let us know in the comment section. And also if you have any question, let me know in the comment section. I do replay most of the comments. Thank you very much. I'll see you soon in my next video.